Mortgage rates go up, mortgage rates go down. They're constantly moving. I tell you what, it can be downright scary at times. Hey, it's Craig back with another Mortgage Minute. And in honor of Halloween, I was actually going to do this video in a Michael Myers mask, but I got talked out of it. So, anyway, what I want to talk to you about is what's going to cause mortgage rates to go down. Okay. And here's why I think this question's important. I talk to a lot of people in what I do day to day, and I hear a lot from people when they say, "Hey, I know mortgage rates are going to be lower." Okay, and admittedly, I have felt that way as well over the past 24 months that mortgage rates would be coming down. But I think it's important to understand why I have felt that way, and in reality, what would cause mortgage rates to come down. Because not to be a Debbie Downer here, but it's possible mortgage rates won't come down, just so you know. All right. That's not an inevitable conclusion. So, why have I felt, over the past 24 months that mortgage rates would be coming down? And they have come down, to be fair, in relation to where they were last year. The reason I felt that way is I felt like the economy would be slowing down. Okay. Um, and the truth of the matter is, for interest rates to come down, in all likelihood, that's going to be what has to take place. Okay. So, why is that important? Why is it important to understand that? Well, this is going to be a long video. So, if you're not into this stuff, just move on to the next one. But here's how mortgage interest rates work. Okay. For me to be able to give a mortgage loan to somebody at an interest rate of, let's just say, 4%. And I'm using that as an example. That is not where the market is today. But at an interest rate of 4%, that means someone else has to be willing to give up their money and receive a rate of return that, by the way, is not even 4%. Okay. So for me to give someone a $300,000 mortgage, someone else, whether it be a government agency, a hedge fund, private investors, it doesn't matter. Someone else has to be willing to give up $300,000 and receive in return a fixed rate of return. Now, a good way to think about it is, for the most part, if I'm giving someone a mortgage at a 4% interest rate, again, let's use that, the end investor that ultimately gave up their money, they're probably only receiving a rate of return of 3%. Okay. Now, that's a very generic kind of way to explain it. It's obviously more complicated than that, but it is a good way to think about it. When we give someone a mortgage and the rate is 4%, the end investor is not getting a rate of return of 4%. It is less than that. Like I said, it's probably closer to about 3%. So I want you to think about it, because I hear this a lot. Like, oh, I sure wish rates were back at 2.5%. I get that, right? And yes, interest rates were around 2.5% just not too long ago, due to what was going on with COVID and all that kind of stuff. But you got to understand something. When we gave someone a mortgage at a 2.5% interest rate, that means somebody was willing to give up their money for 30 years and only receive a rate of return of maybe 1.5%. Okay. Now, I want you to think about this. If you had $100,000 to invest and I came to you and said, "Hey, guess what? I got a great deal for you. Why don't you give me your $100,000 and I'll guarantee you a rate of return of 1.5% for the next 30 years. I'm going to hold on to your money and give you a little bit by little bit each month. But you're only going to get a rate of return of 1.5%. You would think I was crazy. You'd be like, "No, there's no way, man. I can go get more for my money somewhere else." Okay, well, that's the reality of mortgage loans, right? Someone has to be willing to accept that rate of return. Now, why is that important to understand that? Well, it's important to understand that because we'll get to the meat of what we're here to talk about. What's going to cause mortgage rates to go down is one of two things. It's either going to be that the economy slows down to a point to where investors are willing to accept that lower rate of return because their fears about where else they can invest their money are much greater than that lower rate of return they would be getting. Okay. So if we go into a recession, it is more likely that investors, hedge funds, whoever, is more likely to accept a lower rate of return for the safety of their money. Okay. Because otherwise, their other options are stocks and things like that, which can be more volatile if we are in more of a recessionary environment. Okay. Does that make sense? Now, I said there was two things. The second thing is you could have the federal government step in and buy mortgage-backed securities at a much higher pace than what they typically otherwise would, which is exactly what happened during COVID. Now, I'm going to make the argument that the government's probably not going to do that to a very great extent. Okay, I think the that might only take place if there is a concern about the economy, and if that concern is about um, you know uh, homes not selling because of rates. And the reality is I don't see that being the case. Okay, so what's most likely to happen for interest rates to come down is you're going to see the economy slow down. Now, why is all of that important? If you want to watch, okay, and if you want to kind of predict is a bad word because it's hard to predict mortgage rates, but if you want to see the trend of, okay, this potentially is going to cause mortgage rates to come down, here's what you need to look for: unemployment. Okay, that's the big thing. Now, past few years, people like me have talked about we got to get inflation down, got to get inflation down. That is important, was important, will continue to be important, and I think the Fed has done a great job of bringing inflation down. That will keep mortgage rates from continuing to rise. Okay. But just bringing down inflation by itself is not necessarily going to cause mortgage rates to go from where they are today to dramatically lower. All right. A high unemployment rate would do that. Now, I'm not telling you to root for a high unemployment rate. Okay. I'm not telling you to root for a recession, but I think the reality is if the economy is doing well today, continues to do well, or even does better, the likelihood of mortgage rates being low as a result of that is not very good. And that's just the reality. So, not saying I think rates are going up. I'm not saying that I don't believe that rates will be coming down. I still believe there's a likelihood of our economy slowing down at some point. I think we've gone through a time period of kind of a bounce back from a pandemic, and guess what? Those things don't happen very often, so it's hard to analyze how long it takes to truly see the unwinding of that. That's my opinion. I do believe this very strongly. If we have a robust economy today, and if that continues, I don't necessarily subscribe to the theory that mortgage rates are just arbitrarily going to be lower. Okay, if you start to see unemployment tick up, if you start to see the economy slow down, if we do in fact go into a recession, I do believe at that point that mortgage rates will be lower. So, not making a prediction. I'm just telling you what you can kind of look for. So, if you have questions about that, would love to talk to you. The reason I think that's important is I think there's a lot of people that are holding off on buying a home, thinking that, hey, I think after the first year, mortgage rates would be coming down. That might be true. But I think it's important to understand, okay, well, what's going to cause that to happen? Because if nothing else changes, that's probably not going to be the case. And you're missing an opportunity to own a home today. You're missing an opportunity to build equity today because home ownership is very strong in the US and owning a house is a really good investment. And I don't want you to miss out on that, expecting something to happen and not understanding the background of what would cause that to happen. So if you've got questions, call me 615-498-5626. I told you this is going to be a long one. I appreciate you hanging out with me and I appreciate you watching.